Good morning, everyone. And it is a pleasure to be here in PMS Bazaar today. And thank you for the opportunity. And also, it is exciting to see the theme that PMS and AIF is a necessity. I, I, I can clearly relate to that. And also, big congratulations for the PMS, AIF Bazaar launch also. So, what I would like to cover in this, quick 25 minutes presentation is some of my experience and also how it is related to the way we are structured at ASK in terms of our thinking process and how we like to deliver the sustainable, consistent returns for our investors. So, a lot of changes since I came in May 2025. I've taken charge of ASK equity, PMS, AIF offshore, and also the upcoming mutual fund. And I'm responsible for that business. So what I've gone through and did deep dive and seen what we need to do and how we want to structure ourselves. So some of the glimpse of it is visible in this presentation. So to start with, I have almost 35 thanks to my dad who introduced me to markets in 1990 with a bunch of investment books on my birthday he gave me, and that changed my life. I never knew that I'll become an analyst or a fund manager or a CEO, but I knew that I'm very passionate about equities. It's very challenging, and 1991 he gave me small money to invest, and within 5 months Harshad Mehta scam broke out, which gave me clear lessons that what I invested became one-fourth very fast. So starting from there, a whole journey of various market situations, I would like to quickly take you through some of the key learnings and how we should think about each one of you is an investor by yourself. Also, you'll be a fund manager for your clients. But at the same time, I think, I'm a fund manager for all of you. So some of the traits in which, we should behave is one and the same. And this particular chart, which speaks about the market movement over the last 35 years, which I've been part of. And if you look at, it's a 4 different colors in which it is mentioned. The first decade, if you see the headline, what it's talk about is the decadal shift. This is something which has to be very clearly understood. Markets don't behave the same way at all points in time, and it is easier to maybe prepare yourself for a decadal shift than a monthly shift or quarterly shift or a yearly shift. So what I always look forward is, what is happening in the market, and is there a structural change happening in the market, and probably recency effect of the last 10 years or last few years. That what has been the biggest performer in the last 5 years? Which sector is the biggest performer? Commodities is the biggest performer. Who on earth would have thought in 2020, post-COVID, commodities is going to be the biggest performer? And real estate commodity index has gone up almost 6x. And real estate index has gone up 5x. Nobody would have thought in 2020. If you don't have a preparatory framework or an approach towards this, you will not be able to pick those stocks, right? So what this cycle talks about is 1991, Mr. Manmohan Singh came with his dream budget as liberalization and opening up the economy happened. Then you saw the Harshad Mehta boom in the markets. And 1992, the Harshad Mehta scam broke out and the markets fell. Post the correction of Harshad Mehta scam, what sectors picked up as the biggest winners in the next decade was technology, media, telecom stocks. So TMT rally, which is more driven a global rally, you saw those stocks doing very well. Then you saw a massive correction in the technology stocks or dot-com bubble burst happening in the year 2000. And then, the next decade, it was an infra-led decade. Infrastructure sectors, commodities, utilities, PSU banks, all did exceedingly well in the next decade. Then you saw the global financial crisis hitting in the year 2008. And, market fell by almost, Nifty fell by 56%. And post that, there was easing cycle. Then, you saw the market shaping up in a different fashion in the next decade. So 2010 was a peak of, all the infra-led sectors. And then you saw PSU banks peaked out in 2010 November, and post that, in the next decade, you saw the consumption-oriented companies, what you call as the, the Asian Paints and Pidilites of the world, and Trend, whichever is a distribution-led businesses, B2C businesses, they all gained scale and theme. That theme worked beautifully for the next decade. 2000, COVID crash happened, 40% market corrected. Post that, what is working is exactly opposite of what you saw in the previous decade. The consumption stopped working, and you saw the repeat of 2000 to 2010 in some shape or form. So if you connect this with the global macro outlook, you get a lot of learnings saying that, okay, this macro events have tailored for this particular market situation. So for example, in March 2020, interest rates globally bottomed out, inflation bottomed out, it almost became zero. So the narrative at that point in time was, markets will reward the consumption oriented companies more because the multiple should be much higher because the interest rates are low. When the cost of capital in the country goes low, the valuation should be higher. All those theories completely collapsed, and you saw the interest rates in US moving to 4.4%. I have not seen in my lifetime, in a matter of 5 years, interest rates in US moving up by 4.5%. It's a massive change in the dynamics, and inflation protection sectors are the ones which performed post that. So every decade is a new decade. And I tell my daughters, to my kids, saying that, what is the easiest way to pick stocks? When you see a massive crash, in summary, the slide, the decadal shift summary, what I want to say is, if you see a massive correction, when I say correction, 25% plus fall in the markets, the tendency is that, what has been working for the last 5, 6 years or 7 years, you go and buy, right? Because those also would have fallen. But you have to go and buy the sectors and stocks which has not done well for the previous decade, and that's where the value will be, and that's where the opportunity lies. So having said that, this decadal shift, you can prepare yourself, you can look at the market situations, and this is much more easier to predict than the daily options funding people are doing at this point in time, or investing in stocks for day trading. These all are very difficult to maneuver, but if you're thinking a little bit long term, this preparation is pretty much easily possible. So these are the market situations which I already covered through. There's a period where pharmaceutical sector went through the roof in 2016, and then post that for a long time it didn't perform. So you have to look at within the consumption boom, the sector which did very well is some of the financial services names which were funding the consumption boom, like Bajaj Finance is a case in point. It moved up 175 times in this decade, 2010 to 20 decade. So identifying the winners, looking at the market cycles is very important. So when you have various market situations like this, what will help you to take these decisions? You need to have a very strong investment philosophy with you. You need to think, what will work for me? How can I prepare myself? How do I prepare my portfolios for my clients in a very decent fashion? And that's where the investment philosophy comes into picture. So for any investment house, if you have a strong investment philosophy, you can play through different market cycles very well. So we have an investment philosophy, which we have, through our experience, what you have seen and what is working. That is something which we have institutionalized at ASK, which is called focus investment philosophy. Focus means, it's basically you focus on your work. The investment team also understands that, this is something which we need to, very granularly take through and assess whether it is working in the right fashion or not. So fundamentals are very important. So when you look at focus, is fundamentals, opportunities and scalability and cycles, and capital allocation of businesses, unmatched moats, it's a competitive edge in the market, and margin of safety. These all are very essential to be looked at, and that gives you the edge in the market to decide and prepare yourself in the marketplace. So when you say fundamentals, what quickly comes into my mind is, the balance sheet health of the businesses. the quality of the balance sheet. People call it as the structural stone which is required for any business to do well. If the balance sheet is not in a good shape, the business cannot do well. So look at how good the balance sheet is. This is where the research comes extremely important. So we have a bunch of analyst team whom we have developed over a period of time. We have more than 10 analysts and a head of research, extremely experienced team which we have put in place, CA rankers, and I am grads who are working day in and day out to understand what is the structural benefits this business has, how the quality of the balance sheet is strong or not, profitability of the business, the structural growth element, the structure of the industry. All these things are very critical while we are evaluating a business. So fundamentals are very critical. So ASK stands for the fundamentals in the first place. Now coming to the opportunities at scale, right? So last 5 years, it is easily visible. You look at the government allocations into capex, it has been increasing consistently well, right? So easily you could have assumed that this is a change. The capex is increasing from 4 lakh crores, it has moved to 11 lakh crores in a matter of 5 years. There is a 22% CAGR, it is growing. So when you see that change, that is where you have to see that, okay, maybe this is coming into the public sector enterprises. Which are the sectors which is attracting the capex? Maybe there is a case to look at. So 2020, if you had looked at the numbers which is panning out and also the profit pool increasing, it was very clear that defense sector was attracting a lot of capex. Railways, defense, ports, all of them. So opportunities and scalable opportunities identifying is also very important alongside, while doing the research. So fundamentals are important, but at the same time, the scalability of the opportunity. Moving on. So these are the different, we already spoke about, different market situations which we have envisaged, has come across in the last 35 years. And always people look at the recent events like tariffs. And, these are all things which probably you might, lot of noise it creates, but, ultimately it is not going to add value. You have to look at the fundamentals of the business. You have to look at the future prospects of the businesses. You have to look at the market scenario, the decadal shifts, cycles, the themes which can work. All these will help you to take different, different bets and decisions during this period. In terms of spotting the cycle, the upswing in the cycle, if you see the NPA rise, which is well talked about in the case of PSU banks, between 2010 to 18, the PSU banks were seeing, or the NPA in the country was growing significantly higher, the non-performing assets, and because of which the bank balance sheets were getting disturbed and ruptured, which has actually peaked out in the year 2018. So for example, in the year 2019, if you would have looked at the trend of the overall NPA in the system, it went up to 11.2% and it was declining. You could have easily figured out that there is a case for the PSU banks improving their balance sheets, or the banks which are heavy on NPAs going to improve, and that is a case where you could have captured the PSU bank rally, and the PSU banks did exceedingly well for last 5 years, which is the banks which did very well. PSU banks and ICICI Bank, they were heavy on NPA in 2020, and those were the massive recovery cases in the last 5 years, which actually benefited these banks. But going forward, in my view, next 5 years, what is to be looked at is more of a credit growth led play, and that's where probably the private banks will become the winners in the next 5 years. So, moat advantages. When you say moat advantages, it's basically the strength of the business or quality of the business. It includes the franchise value. It includes the network effect. Say, for example, I'm just taking an example like Bombay Stock Exchange, or CDSL, or some of these names, NSE, which is not listed, which is much more easier to talk about. All these companies are having huge network effect, huge number of customers. Small changes in the transaction fees, it increases the profitability, which Warren Buffett talks about, Coca-Cola investment. one bottle, few cents increase in price, millions of bottles sold in a day, therefore the profitability increase is significant. That's called network effect. Franchise value. Some of the big banks, which is now today trading at, probably at a 5-year low valuations, people are not thinking about the franchise value it has. And maybe there is a case to think, is it the best possible time to include in your portfolios? And that's what, we do at our end. So network effect, brand power, brand sells their products on its own. You have the customer loyalty, and also the economies of scale, which we spoke about, and regulatory. Some of the big businesses, what we see today, the economies of scale, it has gone to such an extent that, the second player is not possible to compete out. That is where, the scale becomes a significant advantage and a moat. So we look at this very carefully. For example, at ASK, we have been owning, say, for example, Bajaj Finance, which is a much more celebrated NBFC over the last 2 decades or 1.5 decades. We have been owning this all throughout, mainly because of the ability we could spot it when it was a tiny cap and holding on to it all along, because we see that, the possibility of a scalable opportunity there. Coming on to, this is a very, very critical in investing. When you invest, you have to buy with a safety, right? You need to have a safety margin. And this is where majority of us make a mistake. Good business doesn't mean that, good price to buy, right? So gold also at a wrong price, you lose money. So this I tell my team every day, when you're buying a business, you might feel that business is structurally well equipped to grow, but, probably market rewards it much earlier and it is already in the price. So having a good margin of safety, which Warren Buffett, Seth Klarman, many of them speak about it, that gives you the potential good long-term return experience and good investing experience. So this is something many times we miss out. As I mentioned, the consumption boom peaked out in 2020 and the valuation was obscene, the market caps were obscene, and also the margins and growth was at the peak. Probably you could have asked a question saying that these valuations are sustainable or not. And the interest rates are moving up. The narrative was the interest rates will stay low, and now the interest rates are moving. All the factors which are giving the high valuation is changing. So that's probably the time where you have to rethink, is it the time I have to be in this set of stocks or should be out of it? Moving on. Yeah, so stewardship, or, say, for example, the governance and stewardship is something which is less understood many times. In my entire fund management journey, I have seen that many times some of the banks, which is now from a large cap bank, which has become a penny bank, or, it's a tiny cap bank. Many times, people go and bet heavily at the peak valuation, thinking that, this can grow till the sky. And that's where, and, if you are not glued on to this governance part or the integrity part of these businesses, you make a massive mistake. Generally speaking, most of the businesses come with a true and fair approach, but there are many cases, bad apples in the whole basket. You need to be aware, what you need to pick and choose. So when the IPOs are coming, people get excited. When the QIPs are coming, people get excited. I have seen the cases where the fund managers queue up. You did a four times book, 5 times book, you're ready to pay for buying a bank stock in the QIP, and later on the stock is now available at 0.5 times book, right? So it repeatedly, it reminds us saying that, okay, you need to play a lot of focus on the governance and look at the integrity of the management, the capital allocation history, the resilient management, and also the focus on the risk management efforts. So some of these, we have heard, this very, very important quote from Warren Buffett says that it is far better to buy a wonderful company at a fair price than buying a fair company at a very attractive or wonderful price. So which again, talks to the same language, saying that, even if it is a very, very well-run business, but buying at an attractive price or a right price point is very important. This is where the research comes into play. So many times my CA friends, CA batchmates used to call me and tell me that, George, whenever I invest in a stock, that stock starts going down. And whenever I see that, whenever I sell the stock starts going up. This typically happens mainly because you are not understanding, you know only the price. You don't know the value of the business, right? So this is where the entire attempt, with the analyst team, fund managers also make mistakes. I will also make my own set of mistakes. But the point is, you need to be glued on to the valuation aspect and, the margin of safety, what you're paying while you're buying. Some of the IPOs, when I evaluate, which has recently listed, in next 20 years, those price points cannot come, right? So to me, it looks like absurd valuation at which some of the IPOs are coming, and people are ready to pay. And the social media is enough, and then more to create propaganda very soon. In the times where I started investing, there was no internet, there was no mobile phones, right? So there is very difficult to get the information. Today, information is plenty, price is known to everyone, but value is not known to many, right? So when you look at from the allocation perspective, what I've realized over a period of time, especially 2008 taught me, saying that, markets can fall, like small cap index fell almost, 80% in 2008. So that taught me saying that, if you don't allocate money at the right place at the right time, it is important, and thinking it a little bit structurally, you can lose almost 80%, 100% of your wealth, right? You might be saying that I'm doing SIPs, but SIPs also over a period of time becomes a lump sum, right? So you need to be careful about what kind of allocation you're making. Is the decadal shift in the asset classes you are making in the right manner? And also having the right allocation to the right set of sectors is giving you the yields. That's very important. 80-85% of the wealth is created by the right allocation rather than timing on a daily basis or weekly basis. So if you look at the structural decade, when I look at from various aspects of the business, and also the economy today, to me it looks like a very interesting situation. All the corporate balance sheets are cleaned up over the last decade. Bank balance sheets are cleaned up, and also the interest rates are low in India. Inflation is low. You are seeing a very stable government, and also you are seeing the policy initiatives more progressive in terms of growth. Capex is happening from the government side in a very, very formidable fashion. And private capex, as we speak, private capex to sales is increasing for the BSE 500 companies from FY22 onwards. I'm seeing a very, very interesting environment for the next level of growth to kick in. So to me, the next decade is going to be one of the most exciting decade of investing opportunity. And this kind of environment I have not seen in the last 35 years. So the way to think about it is India moving from a per capita, already spoke about in the previous speaker. You see the per capita income moving up, $2,300 per capita moving to 5,000, 6,000, whatever it may be. $3.5 trillion going to $8 trillion in whatever time frame, 5 years, 7 years. Current market cap, $5.4 trillion, moving to $10, $11 trillion, which is equivalent to China in next 5 to 7 years. These are all very, very high probable events. Now, you can think through whether the capital market theme is going to work, defense theme is going to work. You can relate to these factors. Globally, the allocation towards defense is going up significantly. Is this the time to think aggressively on this sector? People say that it is overvalued and so on and so forth, but see that whether it is making sense. So to me, it is one of the most exciting decade. The private capex picking up is going to be massive in my view, because the corporates can spend without leveraging too much. And that is the phase we are entering. So last 5 years, more of repair, the initial set of capex has happened. Next level of capex is going to happen from the private, and the growth, world growth, if you see, it is a much more lower situation, and probably there is a case to accelerate. If you see the China, growth is slow. India growth is again, India is one of the brightest spots. The FI flows is going to be massive, which has been very benign in the last 1.5 years. So when I look at all these key elements which we have highlighted, there are many other themes which I can talk about, is on a massive uptick. Now, greed and fear keeps coming in your mind. Last 1.5 years, markets have not moved much. So people say that, okay, now is the time to get out of the markets. You get these kind of feelings, but to my mind, the risk on environment has already started, and probably you will see next 18 months a reasonably good returns possibility in the markets. That's my view, and that is a house view at ASK. And this is the time to probably look at maybe the large companies doubling their profitability. I can see, and the valuations re-rating in some of the large nifty companies itself. Some of the companies which are generating 65,000 crore profit going to 1,30,000 crore profit, I can see in large companies itself. When that happens, the stock is going to double. So the market cap of those companies are going to double. So whenever you see these kind of environment, that's where you have to place your bets. Some of the maybe third grade small cap, it is not, I can't see 100%, 200% kind of return possibility in some of these names. That's where the opportunity lies. So when you have all these greed and fear hitting you, that's where you think about how your investment philosophy, consistent investment philosophy. My recommendation today to all of you is, if you are managing clients' money, you need to have an investment philosophy for yourself. How do you allocate money to different asset classes? How do you allocate money to different segments of the market? These are the four quadrants I always keep in mind, and I tell my team also, this is what I've learned over the last 35 years, how to make money. There's no other third, fourth, fifth way I know of. How to allocate properly, how to allocate to the different market cap segments properly, different sectors and themes, and all these the first three quadrants which I spoke about, you can do it with a lot of data intensive tracking, right? So we have institutionalized a framework to look at data very, very solidly to see that where we need to place our bets. And stock selection, there is no needless to say, that is where entire efforts to go and, to give an extraordinary alpha, right? At ASK, this is a value proposition from our side. Basically 40 years into the business of starting with advisory in 1983, and then 1993 onwards, we have been in the business. 1994 onwards, we are in the PMS business, and we have managed clients' money over a long period of time. And that legacy, there are downturns, there are upturns in the markets, and different situations we play at different points in time. We have been always growth focused, quality focused, and also governance focused and long-term thinking always inbuilt into our framework. So cycles will change, focus doesn't, and that's where I would like to stop my presentation. And we don't like to time the markets, but we build philosophies like focus investment philosophy spoke about, which will outlast the different times of the market. So we are super excited to be here today, and thank you for your valuable time, and would like to connect with all of you in due course. Thank you so much.